But in all, it is Friday, the 20th of December. This year is blasting by. I'll be writing 2025 on my checks and stuff and whatever else I write dates on before I really get used to writing 2024. So maybe you're all in the same boat, right? The thing is going way too quick, in my opinion. So let's look at a couple things here. I'm going to show you a couple articles that you can look up, check it out for yourself, understand these things, get familiar with it. So you've got the Street, which you've got Jerome Powell talks about inflation, a weak housing market, saying this is going to continue on for years to come. We may not see their 2% target till 2027. We're going to have housing costs continue to grow. I mean, just look at this, the housing market supply. And they're asking for federal government intervention for supply. Every time you get the federal government to intervene in anything, it creates problems. In fact, you don't just, we'll talk about the problem itself that we're up against. Another one that you want to take a look at is, let me see here, Mortgage News Daily. They're talking a little bit about, why is it that every time the Fed lowers the rates, the rates actually go up? Why is it not affecting the interest rates on mortgages? They get into a little bit of that here, right? Some of the stuff I agree with, some of it I don't 100% agree with. But for us to understand what's driving interest rates, everybody keeps freaking out. Why is it every time the Fed touches it, it goes down? Or it doesn't go down, his goes down, but this goes up. Guys, they already baked into his cuts a long time ago. When the year started, 2024, they baked in 5 cuts. We've only seen 3. I was anticipating only 1. In fact, it would have been better if we only had 1. Because we've seen every time they touched it, it's jumped. Let's take a look at the mortgage-backed security so we can just kind of reference that again so we can see. What do I mean by that? These jumps. So we have every time the Fed has touched that interest rate, we've seen it jump. So that being the case, especially right here, touching it, bam, bam again, bam again. So we're getting these drops in the mortgage-backed securities, which is a spike in interest rates. And everybody's like, why is that the case? Why is it that what caused all this? What caused interest rates to do this anyway? Well, let's get back into the full chart so we can see all the way back to 2008, and so we can see what caused it. All of this caused it. All this, pushing all this money, this represents from right here all the right here, $8.9 trillion plus going into other markets of money going in from the federal government, U.S. Treasury through the Federal Reserve, buying mortgage-backed securities, push interest rates low. That's what's caused it. It's not what Jerome Powell is doing. It's not the mortgage companies. I mean, it's a part of our interest rates, honestly, is FHFA. You put a government into it. They started the Federal Housing Finance Agency when they started putting Fannie and Freddie in conservatorship. Those guys need to get paid somehow. So, and we don't have any tax dollars to cover it. So how do they do that? They add margin to your loan. Elon, Vivek, get rid of those some bitches. Turn Fannie and Freddie back on their own and make sure they're doing shit right. Of course, there's laws to protect people from them screwing them, but get that other group out. Get that out of there, and we'll see a drop in interest rate right away as long as Fannie and Freddie don't try and keep that money. If they cut that out and then cut that margin out, you guys will see a drop in the interest rate. That's just my opinion. So what we had, interest rates jumped with the Fed dropping the interest rate, had another day of it jumping. Then today we had a little bit friendly PCE, which brought it back up, and we're going to head back to this level here that we'd marked. So we'll see if we can get above it. It's now, I'm going to actually need to mark this as red because it's now a ceiling. This is not a floor. This is not going to support us. This is actually going to stop us. These levels here that I've referenced previously, these are now ceilings. We're going to have bond-friendly news to break through this. Are we going to have bond-friendly news? I don't know. It might be a very long time because of inflation. Inflation is continuing to rise. That's why we're seeing all this. It's not under control. You can't have 13 years of dumping trillions of dollars into the economy, free money, people going nuts buying shit, and it been under control in a couple of years. You can't do that. This has only been started in 2021. We're 3 years into this. It's the late 2021. So 3 years into this control of the 13 years previous. It's going to take a while to right this ship. What does this mean for you? We're not going to have housing get under control in any time soon. It's going to keep going up. Even if we achieve 2% inflation, it's still 2% above what it was the previous year. All the inflation we have seen is baked in. We're not going backwards anytime soon unless we see some sort of crash, some enormous crash. And we don't want that. None of us want to crash. So you're always going to see costs go up. So if you're sitting here wondering, these other lenders say the rate's going to go down in 2025, they don't freaking know. What we do know is we have this monster barrier above us right here. And we have talked about this barrier over and over and over again constantly. And it seems like there's so many people that don't get it. Well, this other lender said this, or the guy who runs UWM said this. They don't have any clue. But what we know is this thing has proven itself to be one formidable force. Right here, this monster wall. If we can't get above that, we're not going to see any rates lower than what we saw earlier this year. Lowest interest rates we saw was September 13th, 14th, 15th of this year, 16th, something like that. That's the lowest we saw. If we see that's the lowest we will see, my opinion. If you believe differently, believe differently. But I have all the receipts right freaking here since they got done with quantitative easing, went into quantitative tightening, now we're into somewhat of a market that's dictated by people buying the bonds and the news. I don't know what more to show you. So if you're sitting there floating around chasing an interest rate, chasing a lender that's going to give you the rosy story, their interest rate's going to be better tomorrow, wait to lock before the Fed or wait till after the Fed talks. I want to tell you guys, you listen to the wrong freaking people. These guys, some of these guys haven't been in the industry but 5, 6 years. And if they've been that little amount of time, they have no clue. I've been doing this since 97. I got teams members that have been doing this since the 80s. That's it. That's all I got to share with you. Got some news coming up. So subscribe. Be ready. I have some big freaking news coming up. So I'll talk to you guys real soon.